The future of work is a hot topic, and the Resolution Foundation's labor market outlook for Q3 2025 sheds some light on the current state of employment. But here's where it gets controversial. There's a disconnect between official statistics and real-world data, leaving us with some big questions. According to the Resolution Foundation's estimates, employment and the employment rate are on the decline. However, official statistics based on the Labor Force Survey, LFS, paint a different picture. The official data suggests unemployment has risen and the labor market is becoming less tight. But is this the full story? Using a wide range of data sources, we can confirm that unemployment is indeed rising, and it's likely sitting close to the LFS estimate of 4.7%. This, along with other indicators, shows that the labor market has loosened significantly over the past year, even more so than before the pandemic. But here's the twist. Pay growth remains surprisingly strong, despite the loose and loosening market. These data discrepancies also impact our understanding of economic inactivity. While the LFS data seems accurate regarding the level of inactivity, the recent changes it suggests are off. Our estimates indicate that labor market inactivity has risen by about 1% over the past 2 years, contradicting the official data's claim of a decrease. In our Lifting the Lid section, we dive deeper into these issues. We explore how employee numbers from the LFS compare to other data sources, the reasons behind the falling employment rate, and the sectoral and occupational patterns in vacancy declines. So, how tight is the labor market really? Data problems have cast doubt on official measures of unemployment and labor market tightness. The number of payrolled employees in the UK has taken a sharp dip over the past year. And with a rapidly growing working age population, the employment rate has followed suit. Does this mean unemployment is rising and it's becoming easier for firms to find workers? These are crucial questions for both macroeconomic and labor market policies, but they're not easy to answer. First, there's a statistical reason. Issues with the ONS's Labor Force Survey, LFS, make it challenging to assess the UK's labor market accurately. The employment rate and unemployment rate are vital statistics, but they're not the only indicators. We can estimate the employment rate using HMRC and ONS data, and this suggests a rapid decline, contrary to the LFS. Second, there's a conceptual reason. Labor market tightness is a complex concept with no direct counterpart in official data. Yet, it's a key factor in labor costs and inflation. If workers are quitting and firms struggle to fill vacancies, production costs rise, and firms may increase prices. In this outlook, we aim to clarify these issues. We ask, how reliable is the LFS unemployment rate? How should we assess labor market slack? And how tight is the market as the employment rate falls? The LFS appears to be doing a good job measuring unemployment. It's an essential indicator impacting individuals' health and well-being. Despite concerns about its accuracy post-pandemic, the LFS seems to have handled unemployment measurement well throughout the 2020s. To validate today's unemployment rate, we can examine various labor market series, like the claimant count, vacancies, wages, and hiring difficulties. These data sources suggest that unemployment is rising, in line with official data. But labor market tightness is about more than just unemployment. It also depends on the number of workers firms seek to hire, and how easily job seekers and employers connect. Multiple indicators suggest the labor market is loose and loosening. Of the 12 indicators in Figure 3, all but 2 suggest more slack than a year ago. Hiring conditions, vacancy rates, and employment growth all point to a loosening market. However, nominal wages are still growing at a rate consistent with a tight labor market. The strength of wage growth remains a puzzle. While pay growth has been decelerating as the market loosens, private sector growth remains about 1% higher than expected. The Bank of England also notes a high, unexplained component to wage growth, not attributed to productivity, slack, or inflation expectations. Changes in workforce composition towards higher paid sectors may contribute, but much of the puzzle remains unsolved. In summary, the LFS seems to be providing an accurate read on unemployment. This is good for UK statistics credibility, but bad news for households. With more people seeking work, it's also concerning for policymakers, especially with the implied rise in the inactivity rate. Wage growth that appears too strong to be sustainable may have slowed any interest rate adjustments the Bank of England would have made in response to the loosening labor market. The Lifting the Lid section explores three key trends. First, the falling employment rate is no longer solely driven by population growth. Second, administrative data shows a decline in payrolled employees over the past year, not reflected in other datasets. Finally, vacancies have fallen most in industries and occupations with the lowest pay, potentially impacted by recent policy changes increasing the costs of employing lower-paid workers. These findings raise important questions and highlight the need for further discussion and analysis. What are your thoughts on these labor market trends? Do you agree with the interpretations and conclusions drawn here? We'd love to hear your insights and opinions in the comments below.